If you've ever looked at your bank account at the end of the month and just thought, how is it possible that I keep earning more, but I never seem to actually build anything that stays or grows? If that sounds familiar, then today's deep dive is going to hit right at the heart of that frustration. We're talking about a really fundamental mindset shift. It's this pivotal, almost invisible change in identity that separates people who feel stuck in that exhausting earn and spend cycle from those who are slowly, quietly, but just relentlessly building wealth. So we've titled this deep dive, From Consumer to Owner, Shifting Your Money Identity.
I love that.
Our mission today, it isn't just about budgeting or, cutting coupons. It's about understanding leverage.
Yes.
We really need to figure out how to stop being just the passive buyers of products, the shoes, the phones, the streaming services, and start actively owning tiny little pieces of the companies that make and sell them. Because every single time you spend money, someone else is getting paid as an owner. And the entire focused goal of this discussion is to get you firmly on the ownership side of that equation too.
Right.
And to guide us through this, I am so excited to be joined by someone with a truly unique perspective. He spent years inside the engine room of these huge consumer brands, deep in marketing, literally working on the campaigns that convinced millions of people to buy things right now.
That's right.
And now he's dedicated to helping people reverse that training, helping them shift their mindset to become owners instead of just relentless customers. He's seen both sides of the curtain, and I think that perspective is just invaluable.
It is absolutely true. And I'm particularly excited about this topic because I am proof that this shift is possible. I used to be the person who devised the limited drops, the scarcity campaigns, the emotional stories that convinced you to hit add to cart. Now I'm the person saying, that's cool, enjoy your purchase, but let's also make sure we get you set up on the ownership side of the ledger so your money is working for you, not just flowing out to us.
That duality is just so powerful. You've seen the consumer machine from the inside. You know exactly how all the levers of spending pressure are pulled.
Oh, absolutely. I've watched from the inside people dedicating massive amounts of their income and, just as importantly, their time and their emotional energy to consumption. I saw them line up outside stores for a new product or post these huge shopping hauls online, only to turn around and tell me with real stress in their voice that they can't afford to invest. And I really want to emphasize that I say this with compassion because I lived that exact life too. I had a high-earning salary, but I was still at my core a high-earning consumer. The hidden truth, the one the consumer machine relies on us not knowing, is that for most people, the issue isn't a fundamental lack of money. It's that nobody ever taught us how to systematically and automatically redirect even a tiny percentage of our existing spending toward owning assets that grow. We were taught to spend 100% of our surplus, not to allocate, say, 10% of it to ownership.
That brings us right to the origin story of this shift. You weren't born knowing what a Roth IRA was. So tell us about the financial messages you got growing up and where that gap was.
Definitely not. My childhood financial mantra, and I think this is so common, was basically work hard, save a little, pay your bills, and above all, don't take risks with money.
The don't lose it mindset.
Exactly. There was this persistent undercurrent of scarcity, Even if we weren't really struggling, the system I learned was totally linear. You earn money, you cover your bills, and if there's any small miracle of surplus left, maybe you put it in a savings account earning nothing, or you treat yourself because, hey, you deserve it.
And the idea of making that surplus work for you
was completely missing. Any conversation about ownership or investing, it just wasn't there. I was well into college before I even realized that a basic stock wasn't some abstract thing only used by Gordon Gekko on Wall Street.
Right.
It was literally a tiny piece of a company I used every single day. I didn't know what an index fund was. I had no idea how a 401k was different from a standard savings account. Right. That education was just, it was not part of my world.
It's just astonishing, isn't it? We learn how to calculate the trajectory of an asteroid, but not the trajectory of our own personal wealth through compound interest. It's a systemic failure.
It truly is. But the realization, the moment it all clicked for me, came when I was deep in my marketing career, working for a huge consumer brand. We would launch these massive, carefully planned campaigns, think like the newest phone or a limited edition sneaker. The whole psychology was geared toward creating hype and immediate spending.
The FOMO machine.
The FOMO machine at its peak. And I remember this one high-level meeting. We just had a record-breaking launch weekend. A colleague puts up a chart showing these massive sales figures, and then right after it, a chart showing our company's stock price taking a huge, noticeable jump. And that was it. That was the lightning bolt. I looked around that executive room, and the realization just hit me like a ton of bricks. Millions of people were out there right now using their hard-earned paychecks to buy our product. They were fueling that revenue spike. Meanwhile, the people sitting in that room, the executives, the long-term employees with stock options, they were getting financially rewarded. They were getting paid because other people were buying the products. They were on the receiving end of that entire cash flow.
So you saw the transaction not just as a sale, but as a wealth transfer from the consumers to the owners.
Exactly. I realized that despite my good salary, I was still fundamentally playing the game as a consumer. I bought the stuff. I was the target of the marketing campaigns. But the executives, they were the owners. And they were building wealth passively from that very transaction.
Wow.
I went home that night, looked at my closet full of loyal brand purchases, and the thought was just inescapable. If I had just dedicated even 5% of the money I spent on these brands over the last few years toward buying a broad index fund that included these brands, my net worth would look profoundly different right now. That moment of self-reflection was the catalyst. That's when I stopped just consuming and started learning how to own.
Okay, let's unpack that difference in identity now that we know the catalyst. When you define consumer and owner, what are the practical, real-world differences that someone, an average person with a job and bills can really grasp?
The difference is so subtle in the daily action, but just enormous in the long-term outcome. And it has nothing to do with running a business or being an entrepreneur. Let's just define them simply. A consumer is someone whose primary financial purpose, whether they know it or not, is spending. They work for money, they pay their bills, and then they spend the rest on immediate satisfaction. Stuff, experiences, subscriptions.
Okay.
A consumer generally ends the month having built very little or nothing that grows on its own. Their money flows almost entirely outward to fuel other people's businesses.
And an owner.
An owner, in this context, is simply someone who has built a system. They still work, they still pay bills, they still buy stuff and enjoy life. This part is key. They are not hermits living in a cave, but they have institutionalized the habit of regularly taking a small, predetermined portion of their income and using it to buy assets that have the potential to grow or pay them back over time. So things like stocks, diversified index funds, that sort of thing.
The distinction then is purely based on where the money goes right after the paycheck hits. That's that first allocation decision.
Precisely. Look at the typical consumer pattern. Paycheck comes in. First, bills. Then, groceries and gas. Then all the fun spending, shopping, subscriptions, eating out, and the result. Often there's zero left that can grow.
Right. Nothing's left for future you.
Nothing. Now, the owner pattern just flips one step. Paycheck comes in, and then a small fixed percentage goes straight to investing. Then bills and necessities. Then the spending. The consumer and the owner might both spend, say, $300 on fun things this month, but the owner committed $50 to assets first. That small, upfront decision changes everything long-term.
I love that summary. The consumer is basically saying, I only buy what they sell, but the owner is saying, I also buy a slice of the business that's doing the selling.
Yes.
Like, if I buy a subscription to a big tech company service, I'm a consumer. But if I own shares in an index fund that holds that company, I'm an owner, passively benefiting from every single subscription they sell all over the world.
You've nailed it. That is the leverage. You are putting money into the ownership bucket that passively profits from the entire world's consumption bucket.
So if the shift is really just one automated step,
yeah,
why is being a consumer the absolute default setting for almost everyone? It seems, counterintuitive when the benefits of ownership are so clear.
It's not a design flaw in us, in the individual. It's a design feature of the economy. I mean, massive systemic forces are meticulously aligned to keep us consuming because our consumption drives GDP and corporate profits.
So being an owner is like swimming upstream.
It is exactly like swimming upstream. First, we go back to that lack of training. The system just assumes you either learn this from financially savvy parents, which is a privilege very few people have, or you learn it through, painful trial and error later in life. As we said, structured education on personal finance, especially on building assets, is basically non-existent. We learn how to manage debt, but not how to manage equity.
So if your parents were focused on just surviving, not on index funds, you're already starting from behind.
Exactly. But second, and this is maybe the more insidious part, is the consumer machine. The entire modern world is saturated with messages designed to trigger immediate spending. We're not just talking about billboards anymore.
Right.
We're talking about hyper-targeted, AI-driven ads that find you at the exact moment you are most vulnerable to a purchase. That moment of boredom or stress or celebration.
I know this from my old job. We would intentionally use tactics like limited drops, countdown timers, exclusive early access, all to create this artificial urgency and intense fear of missing out FOMO.
Yeah.
This tactic forces you to act immediately. It bypasses the rational part of your brain that might say, hang on, should I really be spending this $150 or should I save it? The purchase is framed as a psychological win, a reward.
And what's the equivalent on the investing side? Is there a fear of missing out on compounding interest, push notification that pops up in your phone? No, there is no index fund influencer creating a sense of urgent scarcity. No company is sending you a push notification on a Sunday morning saying, hey, your future self really needs you to automate that $25 Roth IRA contribution today.
It's just silence.
Total silence. The friction is completely inverted. Consumption is easy, instant, and emotionally rewarding. Opening a brokerage account, picking a fund, setting up automation, those steps, while simple, require intention and time. You have to overcome the anxiety of the jargon. The whole system is optimized for speed of spending, not patient accumulation.
That's such an important point. The difficulty isn't the complexity of investing, not really. It's the lack of psychological support and the overwhelming social pressure to spend instead.
That's the core realization. Being a consumer is the gravitational default. Being an owner is a learned skill. It requires us to build intentional automated walls against that spending gravity. And the fantastic news is that you can start learning this skill at 20, at 45, or at 60. The journey just begins with the decision to learn.
Okay, let's transition into what simple ownership actually looks like. Let's combat that image of the, stressed out Wall Street trader with 12 monitors.
Yeah.
What are the basic building blocks of ownership we should focus on?
Yeah, we want to keep this simple, highly diversified, and honestly, incredibly boring. Boring is excellent for building wealth long term.
Boring is good. I like boring.
Boring is great. So, for the average person starting out, you are primarily buying two things: stocks and index funds, or ETFs.
Okay.
A stock is pretty straightforward. It's a single share of ownership in one company, like Apple or Nike. This is the simplest concept to understand, but it carries higher risk, because if that one company fails, well, your whole investment in it is gone.
Right. All your eggs are in one basket.
Exactly. An index fund, or ETF, which stands for Exchange Traded Fund, is the essential tool for the owner mindset. As we were saying, it's a pre-built, diversified basket of stocks.
Yeah.
So instead of betting on one horse, you're buying the whole race. The most common example is a fund that tracks the S&P 500. This means with one single purchase, you own tiny little pieces of 500 of the largest, most established companies in the U.S.
So the index fund strategy is basically betting on the long-term ability of the American economy or the global economy to grow, rather than betting on your ability to predict which single CEO is going to make the right moves next year.
Precisely. And that's why financial experts overwhelmingly recommend simple, broad, low-cost index funds for beginners, and frankly, for most experienced investors too. You just eliminate the paralyzing stress of stock picking, and you replace it with a highly effective, decades-long strategy. Consistency and diversification. You don't have to be smart. You just have to be patient and regular.
Patience and regularity. That sounds like the exact opposite of the limited drop FOMO consumer mindset.
It is the ultimate antidote. You're getting ownership in everything you already interact with.
Okay, let's make this actionable for our listeners in the U.S. By what mechanisms do we actually buy these index funds? You mentioned three main doors. Let's break those down, especially the tax part, because that's often a huge point of confusion.
Yeah, the three major doors are crucial for building wealth efficiently. Let's call them accounts. So, door number one, the 401k or 403b. This is the one linked to your employer, and it's often a traditional account. The critical feature here is that your contributions are often tax deductible today. This means you're paying less tax on your current income. The money grows tax deferred, but when you withdraw it in retirement, the whole amount, your contributions, and all the gains is taxed as regular income.
Okay, so a tax break now.
A tax break now. Door number two, The Roth IRA. This is an individual retirement account you open yourself. It's basically the mirror image of the traditional 401k. The money you contribute is taxed today. You put in after-tax money. Yep. But the massive, powerful benefit is that all the growth, which can be substantial over 30 or 40 years, and all your qualified withdrawals in retirement are completely tax-free. For a young person starting out who expects to be in a higher tax bracket later in life, this is an incredibly valuable account.
So the fundamental choice between traditional, like a 401k, and a Roth IRA is really about deciding when you want to pay the tax. Do you want a tax break today, or do you want the guarantee of tax-free growth forever later?
That is the perfect way to look at it. For many people, a combination of both is actually ideal for tax diversification down the road.
And the third door?
Door number 3. The regular brokerage account. Some people call this a taxable account. This is the flexible one. It has no retirement restrictions. You invest after-tax money, and any profits or gains are taxed when you sell your investments. This is great for goals that are years away, but not necessarily retirement, like saving for a house down payment or a business fund.
Okay, so the choice of account's critical. But let's address the size of the contributions. The listener's probably thinking, okay, great, but I only have $50 left over. That's a rounding error. I'm not rich enough for this to matter. What's the trap there?
The trap is waiting for permission to be wealthy. That core belief that you need a huge lump sum to begin is one of the most destructive financial myths out there. It's the primary way the consumer identity keeps you stuck.
Why?
Because if you wait for the big raise, you are likely setting yourself up for failure due to something called lifestyle creep. If you're comfortable spending 100% of your current income when you get a $10,000 raise, your lifestyle is extremely likely to just expand to absorb that $10,000.
Because the consumer identity dictates that extra money must be spent.
Exactly. You get the slightly better apartment, you upgrade the car, you dine out more often. If you were a consumer earning $40,000 a year, you just become a higher earning consumer at $80,000, and you still feel like you have no money left over to invest. You haven't changed the fundamental flow of your money.
So the core shift isn't about the amount of money at all. It's about establishing the financial muscle memory.
It is 100% identity training. The owner starts by carving out a tiny, consistent percentage now, regardless of the dollar amount. Every time money flows into your life, some small part of it has to be earmarked to buy ownership. That habit, whether it's $5 a week or 1% of your paycheck, that is the critical achievement. Once that habit is forged, it is exponentially easier to increase the percentage when raises come because your brain has already accepted that a portion of your income is just not for immediate consumption.
Let's make that redirection practical. We need strategies that people can use without feeling like they have to overhaul their entire life or, suffer. This has to feel like redirecting energy, not extinguishing it.
Precisely. The goal is to keep living your life, but consciously skim a little off the top of some discretionary spending and send that money to future you. This should feel smart and strategic, not like punishment.
Okay, let's dive into the 4 redirection strategies you outlined. I want to spend some real time here with specific examples to make it tangible.
Great. Strategy number 1 is percent of spend investing. This is like a form of behavioral tithing. You look at your non-essential spending, dining out, entertainment, shopping, and you just commit to investing a small percentage of it, say 5 or 10%.
Okay, so how does that work in practice?
Let's say you and your friends go out for a big dinner and your part of the bill is $75. As a consumer, that's just a line item in your budget. As an owner, you realize you just afforded $75 of immediate joy, so you must also afford $7.50 for future you. You track this through the week. If you spent $250 on non-essentials, you immediately transfer $25 to your investment account on Sunday night.
I like that. The psychological benefit is that it links the consumption action directly to the ownership action. You can't consume without also contributing to your assets.
It creates this beneficial friction. It forces you to mentally weigh the choice against the cost to your future self.
Okay, what's strategy 2?
Strategy number 2, subscription to ownership swap. This is my personal favorite because it finds money that is already flowing out effortlessly. Most people are subscribed to services they barely even use, a fitness app they forgot about, an extra streaming service, a meal prep box they pause every other month.
Oh, for sure.
Find $1, $10, $12, or $15 subscription that you could easily live without. Cancel it. Now, instead of that money just stopping in your checking account, you immediately set up an automatic monthly investment for that exact same dollar amount to go into your Roth IRA or brokerage account.
So the net effect on your current budget is 0. but you fundamentally rerouted a long-term outflow toward long-term asset building. That's incredible leverage.
It's the highest leverage move for a beginner. The money flow is unchanged, but the beneficiary shifts from a big company to your future self.
Love it. Okay, number 3.
Strategy number 3. Brand to owner shift. This helps anchor the concept of ownership in the real world. Identify the top 3 brands or companies you use all the time and feel some loyalty to. Maybe you're always buying Apple products, or you use Amazon twice a week, or you buy coffee from Starbucks every day. The consumer just buys the product. The owner says, I love and support this brand, but instead of just buying their specific expensive stock, I will commit to investing a recurring amount into a broad index fund that includes these types of profitable, successful companies. You are making sure that a piece of the loyalty you feel and the profits you're generating for them are circling back to your own investment account.
That sounds like a way to stay emotionally engaged with investing without the stress of having to become a single stock expert.
Exactly. You are investing in the entire ecosystem they operate in.
Okay, and the last one.
And finally, strategy number 4, the cash back to investing hack. Now, this one has a big warning. Only do this if you are diligently using a cashback credit card and paying the balance off in full every single month.
Crucial point.
So crucial. If you're doing that, treat that cash back as non-negotiable investment capital. When you get that $50 or $100 cashback deposit, do not let it just merge into your general checking account. Move it immediately into your investment account. It's money derived directly from your consumer behavior, automatically rerouted to fund your ownership identity. It makes your consumption passively work for your accumulation.
These strategies make the process seem less like finding some magical lump sum and more like consciously managing the existing flow of water in your financial life.
It's flow management, not famine creation.
Now, let's get into the structure. Once someone has freed up, say, $50 a month, they hit that wall of complexity. Where exactly should that money go first? We need a clear, prioritized framework for a U.S. listener to navigate that 401k versus Roth versus brokerage decision.
We have to eliminate the decision fatigue here. The priority order is typically dictated by where the free money is. So, priority number 1. Secure the 401k match. This is the clearest, most urgent path to ownership. If your employer offers a match, say they match 100% up to 4% of your salary, your absolute first financial step is to contribute enough to get that full match.
Let's just drill down on the math for a second.
Yep.
If a listener makes $60,000 a year and the match is 4%, they contribute $2,400. The employer contributes another $2,400. That is an immediate guaranteed 100% return on their investment before the stock market even does anything.
It is the only guaranteed 100% return available in the entire financial world. Skipping this is the biggest mistake you can make. You are literally leaving your own compensation on the table. You are being paid to be an owner. So priority 1 is always capturing that full match.
Okay, match secured. What's next?
Priority number 2, the Roth IRA. Once the match is secured, the Roth is an excellent next step because of its long-term tax benefits. Provided you qualify, there are income limits. For someone early in their career, the power of having tax-free growth over 30 to 40 years is it's astronomical. Even if you only put $50 a month in, that tax-free runway is a huge advantage.
And after that?
Priority number 3, the taxable brokerage account, or more, into the 401k. This category is for all your investment goals beyond retirement, or for people who want to invest more than the annual limits allow for retirement accounts. If you're saving for a down payment on a house in 5 years, the brokerage account is the right door. If you want to invest more for retirement after maxing out the Roth, you just go back and increase your 401k contribution further.
That clarity helps a ton. But once they pick the account, say, they decide on a Roth IRA, they still need to choose where to open it. Brokerages have different interfaces, different fees. That choice can be paralyzing. How do we help them pick a platform?
That's a great point. We don't want the brokerage choice to become another source of consumer paralysis. For index fund investing, you just need a large, reputable brokerage that offers low-cost, commission-free index funds.
Okay.
The 3 major players that are excellent for beginners in the U.S. are typically Vanguard, Fidelity, and Charles Schwab.
Right. The big names.
The big names. They all offer commission-free trading, low-cost index funds, and easy online interfaces. Honestly, the specific choice between them is pretty negligible for a beginner. The advice is simple. Pick one of the big 3, Open the account you decided on and move immediately to the next step. Don't spend a week agonizing over which interface you like better. They all do the exact same thing. Action over perfection.
Action over perfection. That should be stamped on the outside of every brokerage account.
Absolutely.
Okay, next step. Fund selection. They log into their new Roth IRA or their 401k. They see this alphabet soup, large cap, mid cap, international bond funds, target date 2055. What's the simple playbook here?
We have to focus on simplicity and broad ownership. If you are in a 401k and you want the easiest, most hands-off approach possible, just choose the target date retirement fund that's closest to when you think you'll retire. So like target date 2060. These funds automatically handle all the diversification and risk adjustment for you over time. They are the definition of set it and forget it.
Got it. And if you're in an IRA or brokerage?
If you prefer a little more control, or you're using an IRA or a brokerage account, just look for two specific names: a total U.S. stock market index fund or an S&P 500 index fund. These funds are the broad baskets we talked about. They're transparent, they're extremely low cost, and they are proven wealth builders over decades. Avoid anything that sounds super speculative or concentrates risk in one single sector or theme. The specific ticker symbol is so much less important than the commitment to low cost and diversification.
So we've picked the account, we picked the fund. The final non-negotiable step to cementing this identity shift is automation. Why is automation the foundation of the owner identity rather than just manually moving money once a month?
Automation is the owner's superpower. It's what removes emotion, decision fatigue, and inertia from the entire equation. Think back to the consumer machine. It relies on emotional impulse. That fear of missing out, the immediate desire for a reward. If you wait until the end of the month to decide if you have enough money left to invest, I guarantee you life will have expanded to fill that space. Or some sudden consumer impulse will derail the whole decision.
Oh, sure.
The owner operates on a schedule. The 401k is automated through your payroll, so it bypasses your checking account entirely. For the Roth IRA or brokerage account, you need to set up 2 auto transfers. Step 1. Automatic transfer from your bank to the investment account. Step 2, automatic investment purchase of your chosen fund within that account.
So, for example,
on the 5th of every month, your bank sends $50 to your Roth IRA. On the 7th, the IRA automatically buys $50 worth of the total stock market index fund. This quiet, repeated action, totally free of your daily emotional state, is how you become an owner. Not by checking the market, but by constantly feeding the assets.
that consistent, boring, scheduled action is what eventually generates the exciting results.
Exactly. Consistency is the primary variable, not timing the market. Not at all.
Okay, we've covered the philosophy, the jargon, the mechanism. Let's synthesize all of this into one unified, actionable plan. The 5-step from consumer to owner starter plan that a listener can physically write down and execute this week. This needs to be a really crisp summary of everything we've built toward.
Let's do it. This plan takes all the anxiety out of that first move. Step 1, notice your top 3 consumer categories. Log into your spending apps or your bank account right now, look at the last month, and just identify the top 3 areas where your discretionary money is going. Be honest. Is it dining out, online shopping, streaming services, drinks with friends? Knowing the target is half the battle.
Identify the leak.
Step 2, decide on a tiny percentage to redirect. Do not aim for a life-changing amount. Aim for a habit-changing amount. Commit to redirecting a manageable 5 or 10% of that non-essential spending toward ownership. If the leak is $500 a month, your commitment is $50 a month. We are trimming, not eliminating.
Okay.
Step 3, pick your first account and open it. Use that priority framework we talked about. 401k match first. If that's secured, open a Roth IRA if you qualify, or a regular brokerage account. If you don't already have one, use one of the big, reputable, low-cost brokerages we mentioned, Fidelity, Vanguard, or Schwab. Just get that door open. Step 4, choose a simple broad fund. Log in and select the easiest, broadest fund available, a target date fund in your 401k, or a total U.S. market index fund in your IRA. Focus on broad ownership and low cost. Step 5, set up automatic contributions. Take the freed up money from step 2, say $50 a month, and schedule it to automatically transfer from your bank into your investment account and then automatically buy your chosen fund. Make the investment happen without you ever having to think about it again.
That is a clear 5-step path that starts small and immediately reinforces that new identity.
And the quiet magic is that the continuous repetition of these 5 steps, especially the automation in step 5, is what quietly shifts you from a default consumer to an intentional asset builder.
Now, let's make these steps really relatable by applying them to a few specific listener profiles so people can see themselves in the plan. I think we need to go deep into the internal struggles of these individuals.
Let's start with profile number 1, Kayla. She's 24, new to the workforce. Kayla is making $42,000 a year. She feels the anxiety of starting her career. Her social life is expensive. About $300 a month just disappears into takeout, drinks, and random Amazon impulse buys. And she constantly thinks, my $30 is too little to matter.
Yeah, that's a common feeling.
It is. Kayla's struggle is feeling insignificant. Yeah. So her owner move addresses that directly. Step 1, she notices that $300 leak. Step 2, she commits to redirecting just 10% of it, $30 a month. Step 3, her employer offers a 3% 401k match. So she immediately sets her contribution to 3%, which is about $100 a month, securing the full match.
Okay.
Step 4, she puts that $100 a month into a target date fund. She also opens a Roth IRA and sets up that $30 redirect to automatically buy a total market index fund.
The impact here isn't just the $130 a month she's now investing. It's the profound change in her sense of self-worth. She's affirming that her money does matter, and she's passively owning pieces of the global economy now, even while she's still enjoying her social life.
That's the key psychological victory. She has leverage now. She's not just a spender. Profile number 2, Chris. He's 35, and he's underutilizing his 401k. Chris makes a great salary, $75,000 a year, but years of lifestyle creep buying bigger, newer, more expensive things have just eaten up every raise he's ever gotten. He has a 4% 401k match, but he defaulted to only contributing 2% years ago when he started the job. He is actively losing $1,500 in free money every single year. Chris's struggle is inertia and missed opportunity. So his owner move number 1 is purely administrative. Log into the HR portal right now and increase the 401k contribution from 2% to 4%. That single action, which doesn't involve any spending change, immediately captures the full $3,000 annual match. He stops hemorrhaging free money.
And since that adjustment happens automatically, before the money even hits his checking account, he probably won't even notice the decrease in his take-home pay after a couple of paychecks.
That's the power of payroll deduction. And owner move number 2 for Chris. He commits that with every future raise he gets, even a small cost of living adjustment, he will increase his 401k contribution by 1% before he decides how to spend the rest of the raise. This weaponizes lifestyle creep against itself, ensuring his raises fuel ownership first.
That's incredibly smart. It guarantees that his wealth trajectory outpaces his consumer trajectory.
Exactly. Okay, finally, profile number 3, Maya. She's 30 and juggling debt. Maya has $8,000 in high-interest credit card debt at, say, 25% APR. She feels immense guilt and she's paralyzed, believing she absolutely cannot invest a single penny until that debt is zero. She feels trapped as a consumer who can't even pay her bills.
Okay, wait, I have to challenge this one. Because the traditional financial advice, the hard math, suggests paying off 25% debt should take absolute precedence over investing money that might only grow by 8 or 10% in the market. Why would she invest any money? Isn't that financially irresponsible?
That is a crucial challenge, and you are 100% mathematically correct. The bulk of Maya's effort, 95% of her extra cash, must go toward crushing that high interest debt because that guaranteed return, avoiding that 25% interest, is unbeatable. However, the reason we still advocate for a tiny ownership habit is purely psychological and identity-based. If Maya commits 100% to debt payoff, the moment she has a small slip-up, a car repair, a spontaneous purchase, she feels like a complete failure. She feels like she's on pause, not moving forward at all.
Okay.
So Maya's owner move focuses on that identity shift. She audits her spending, she identifies a $12 a month streaming service she rarely watches, and she cancels it. That $12 is then automatically transferred to a Roth IRA every month and invested in a basic index fund. Mm-hmm. This small, consistent action serves 2 purposes. First, it maintains the crucial habit of automation. So when the debt is finally gone, she already has the infrastructure and the muscle memory to shift, say, $500 a month straight into investing. And second, and this is the most important part, it affirms her new identity. I am actively fighting my high-interest debt, and I am a dedicated owner. I am working toward both financial freedom and future wealth. She is no longer just a passive victim of her debt.
That reframes this small investment as psychological insurance and habit practice, not as a short-term mathematical optimization. That makes a lot of sense.
The math will follow the identity. Once she successfully pays off that debt, the first thing she does is redirect the hundreds of dollars she was putting toward that repayment and automatically reroute it into her now established investment accounts. The foundation is already built.
That brings us perfectly to the long game mindset, because the math gets you started, but the psychological defense is what keeps you in the game for decades. So we've established the identity. I am an owner. How do we sustain that belief when the inevitable happens, when the market drops and the account balance turns red?
Sustaining the identity is critical because the enemy of long-term investing is the short-term emotional response. When you declare, I am an owner now, you are adopting a durable, permanent worldview. It means you expect volatility and you plan for it. The consumer, when the market dips, sees that red number and thinks, I failed. I should sell everything and stop losing money. This impulse locks in the loss and completely annihilates the power of compounding.
Right.
The owner, who has done the mental work, sees the red number and thinks, this is a temporary price fluctuation. My investment horizon is 20 years. My automatic purchase this month is now buying the same assets, but on sale.
So how can a beginner really anchor this feeling of ownership? What are some practical things they can do?
First, reinforce the action. Look at your account occasionally, maybe quarterly, to confirm the accumulated shares. Don't check the dollar value obsessively, check the share count. Notice that every single month your share count goes up. That is undeniable, tangible ownership.
I like that.
Second, celebrate the contributions, not the balance. The psychological win happens when that auto transfer hits and buys more of your fund. You affirm, I showed up again this month, I did my job, I am fulfilling the identity of an owner. If you wait for the balance to be six figures before you feel successful, you'll quit long before you ever get there. And third, and this is crucial for market swings, you must adopt the decade zoom. Short-term noise is constant. If you look at the chart of any broad index fund over a 30-year span, the crashes of 2000, 2008, and 2020 look like small, temporary dips in an otherwise relentless upward climb. An owner lives at the decades-long zoom level, knowing that short-term volatility is simply the price of admission for long-term growth.
That reframing of a downturn as a sale is truly the mental superpower here.
It is. But to maintain your composure, you need rules. Practical self-regulation. Rule 1. All invested money must be money you are certain you won't need for at least 10 years. This removes the pressure to sell during a dip. Rule 2. Stop checking the market daily or weekly. You are investing automatically. Checking only invites emotional interference. And Rule 3. Commit to the automation even during the downturn. This is the moment when consistency matters most.
Finally, let's talk about conscious consumption. How does this new identity change an owner's relationship with spending in the supermarket or online? Does it just lead to misery?
Not misery at all, but heightened intentionality. Once you really internalize the power of compound interest, that realization that $100 saved and invested today could become $400 or $500 in 20 years, you automatically run a subconscious calculation when you're faced with an impulse buy.
Right.
You're standing there holding a new $150 gadget, and your brain weighs the immediate gratification against the opportunity cost. Is this item truly worth stopping $150 from working for my family over the next 2 decades? You won't always choose the investment, and that's fine, but you become intensely selective. You consume consciously. You stop letting your money just leak out through low-value impulse purchases, and you steer it intentionally toward either high-value experiences or high-value assets. You gain this feeling of actively steering your financial ship rather than letting the consumer current just push you around.
That sense of control is the ultimate reward of the identity shift, isn't it?
It absolutely is. You are not just fueling other people's success anymore. You are consistently building your own on a schedule, free of emotion.
We've covered a massive amount of detail, from the psychological roots of spending to the mechanics of index funds. So bring it all home with the key takeaways.
Takeaway 1. The consumer identity is the default, but it is not destiny. You can be both a consumer and an owner. Just make sure a consistent portion of your earnings buys assets that grow, not just stuff that depreciates.
Right.
Takeaway 2. Ownership is simple, automated, and boring. It means regularly investing small amounts into broad, low-cost index funds through accessible accounts like a 401k, where you prioritize the match, or a Roth IRA, where you prioritize tax-free growth. Takeaway 3, start small today. The consistency of the habit, even $25 a month, is infinitely more important than the initial dollar amount. Do not wait for wealth to start acting like a wealth builder. Takeaway 4. Redirect your existing spending. Use strategies like subscription swaps, percent of spend investing, or the cashback hack to fund your new ownership habit without demanding a complete lifestyle overhaul. And takeaway 5. Owners think long-term. Adopt the decade room, trust the power of automation, and view market dips as a chance to buy assets on sale.
Thank you for providing such a clear, actionable map. This shift really does start small, but has such a profound long-term impact. And now for your simple owner move homework, this week 1 concrete action to really solidify this new identity. Step 1. Open your bank or credit card statement and find one area of non-essential spending, one subscription, one regular takeout order, one category of impulse buying that you can just temporarily trim this week.
Just one.
Just one. Step 2. Take the exact dollar amount you would have spent, whether it's $15, $30, or $75, and manually move it physically into your chosen investing account. If you don't have one set up yet, move it to a high-yield savings account that you've specifically earmarked as your ownership fund. Step 3. When you make that transfer, just stop, take a breath, and consciously affirm. This is me shifting from only a consumer to also an owner. That small, intentional move is the start of everything.
And if you can do one more thing, take 5 minutes to log into your 401k portal this week and just ensure your contribution percentage is set high enough to capture the full employer match. That is the quickest path to getting an immediate 100% return on your money.
You are not just thinking differently, you are actively doing differently. You are allowed to enjoy your life now and build wealth for later. You are allowed to be more than just a customer. You are becoming an owner.
And remember this final thought. The identity shift itself, that core belief that I'm an owner who buys assets consistently, is the strongest, most resilient defense you have against panic when the world inevitably experiences financial turmoil. Focus on cementing that identity this week, and the results will follow.
We'll see you in the next deep dive.